We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Peter Grandich from Peter Grandich and Company. Peter, thanks for joining me today. How are you?
Always good to see you, Tom. Thank you for having me.
Great to see you too, Peter. And we've got a lot to cover today. It doesn't seem like there's ever a lull in subjects to talk about in this news environment. So we're speaking of course today on Wednesday the 16th, and there's kind of big news or more noise, at least, around this idea that Trump really wants to get rid of Powell. So what's going on with that today, and how do you see that situation really having repercussions within the markets and within the debt markets as well?
Well, if I give you a reply and wait 10 minutes, I might have to give you a different reply.
That's the risk at this juncture for sure.
So today, a story ran earlier before you and I started speaking out of the White House that Trump was preparing to fire Powell. And within minutes, the stock market, surprisingly, I didn't think it would cave compared to what I think how bullish it was for gold, but the stock market tanked. And this is a guy that's built himself all around the stock market as his good housekeeping seal. What the stock market does is telling you that what he believes the economy's doing and how great he's doing and all that kind of stuff that goes with it and all. The problem with that is that especially if they're now going to try to use this building that the Fed is supposedly building and it's overrun. Well, if you're going to fire somebody for that, then basically everybody in the White House and Congress has to be fired too, because they all overrun this. It's not like he's done anything different that hasn't been done in Washington in the last 100 years. But what I think he's thinking he's achieving, and what I think the mistake is that somehow magically we lower interest rates just because some guy comes in and decides, hey, we just flood the market, get short-term interest rates down. There's a big reason he wants to do that, and that's because we have to refinance almost $10 trillion in debt. And obviously a couple points shaved off the interest would be beneficial. He's also under the belief that simply lowering interest rates just booms the economy and everybody's happy, and then they're happy with him. The problem that he has is this, Tom, and this is why I've been against it since it first started and put out a thing today when he first broke the news. And that is, we went from $2 trillion was going to be cut in deficits days after his inauguration based on Musk. Then it was dropped to $1 trillion. Tom, they couldn't even get $9 billion across the wire. And what I'm afraid what this would do is this would give clearly indications, especially people overseas, that this is the beginning, if not already the middle, of moving towards a banana republic. Flood the market with cheap money, lower interest rates, create inflation, but somehow that helps a lot of people. And the perception would be, in my view, is extremely bullish for gold, and that's why gold reacted almost up $50 within minutes. Not good for bonds at all. And let's keep this in mind, Tom. I think this is very important too. Despite supposedly his selling that inflation isn't an issue because today's PPI number wasn't as high, even though the CPI yesterday was the second bump up we've had in inflation now over the last 3 months. He is under the belief that he can somehow magically lower rates without any penalty in it. Well, the big penalty would be in the dollar, which is, while it's rebounding in a counter trend rally on a long-term bear market that's begun for quite some time now. I think what this simply does is it's chipping away of the chips that he had when he started this so-called honeymoon period. This Epstein thing is not going to go away. 70% of both Democrats and Republicans believe that they want to get to the bottom of that. So now to just call it a hoax and keep telling everybody, well, I even want to talk about it, raises suspicion. So all in all, Trump is losing the momentum, even on the economic front. Tom, this is now midway through July, and there is no significant trade deal done. Whether if you look at it, obviously with China, Canada, Mexico, some of the other leading partners, and there's quite a talk of opposition by them now that they're not going to cave as he assumed that they would, and the Brics are still moving just forward. I say this, Tom. I know I'm long-winded here, but let me just finish with this part. Who's ever the membership director of Brics has to have a big smile on them. Because at the end of the day, when this is all over, more people are going to want to move away from the United States than get closer to the United States. And that's what the Brics are all about.
Well, and I think you wrote about this recently as really the idea of Trump using a stick instead of a carrot to
Right.
renegotiate these trade deals. So how do you think that, ends up creating a lot more negatives in just the way that he's gone about it? And what do you think the end result of that is?
Yeah, he's been a bully with a big stick instead of going in with an olive branch. Hey, listen, guys, I've taken over, and a lot of this hasn't been unfair. But rather than just doing what he's doing, let's just sit down and see if we can hammer out something that would be better. I think they would have been more conducive to that. Instead, he said in the early days that if anybody dealt with the Brics, he basically was going to break the kneecaps of those people. 100% tariffs and all this type of stuff and all. I just don't think people recognize and you just had to be in the mining business. If you talk to anybody who's in the mining business for the last 40 years, 30 years ago, Tom, you and I could have spun a globe at a mining conference, point our finger, land on some country and go, yeah, we can go there. Not anymore. Not anymore at all. The United States is not anywhere near as popular or welcomed in the same manner that it was 20 or 30 years ago. He's trying to create as if that's how people are going to react. And what's coming around that, which is interesting, doors are opening. And the biggest door that opened, that was an indication in the early days of the trade news, is when China and Japan got into a room with South Korea to talk about a trade among themselves. Mortal enemies, there's no more than Japan and China. The hatred there goes back 700,000 years. But even they were willing to now do something in lieu of being pushed around by the United States. So I just think this short term, he may still get, this don't worry, be happy crowd on Wall Street will play it up and he's doing great and all. But I think long term, he's done far more damage with the big stick than he would have won with an olive branch.
Mhm. Peter, I want to pick back up on something that you touched on earlier, this idea of PPI and it being, coming in a little bit hotter than normal. Is that also kind of surprising because of the way that PPI is constructed? Is that also kind of taking into account the effect of tariffs on the price of these raw goods for these producers?
Yeah, so PPI came out today better than expected and people rallied and all, but you make a very good point that doesn't take into import prices at all, where the CPI does. And the CPI yesterday rose and it rose again. It's gone up twice now in the last 2 months. And there is some seepage where you can see some of that tariff stuff. And by the way, even if some of the countries or companies are eating the cost, they're not going to eat that cost forever. Everything eventually will get passed on to the consumer because profit margins will shrink. Many of these are public companies. The public company shareholders kick up, and the CEO doesn't want to get kicked up because they make a lot of their money from performance equities and things of that nature. So I think the CPI, which is more important to look at in terms of trade than the PPI today, still is not at a level where the Federal Reserve, whether or not there was pressure from Trump, was going to feel it has to. If you look at what they normally look at, whether it should be there or not, the stock market is basically near its all-time highs. Their employment number, which we all know is skewed and so dramatically different if you truthfully look at it the way an ADP does, but from what they're supposed to look at and all, is pretty okay. Interest rates are not dramatically high. I mean, it's off an artificially low. So there's real no reason at this point for them to rush out and lower interest rates. And I also think they say never will impact it, but I think politics does impact it. And I think Powell never liked Trump from day one, and probably vice versa. And I think Powell might have eased otherwise, but actually would hold off hitting the gas pedal for another month or two if it means that Trump doesn't get his wishes. So I think the politics of the Fed are more at play now than in past administrations.
Hmm. But wasn't, if my memory serves me, Powell was appointed by Trump originally in his first term, was he not?
Think about all the people that were once Trump's friends and not Trump's friends
Yeah,
now.
fair.
That's a much longer list than people that weren't Trump's friends and are
Mhm.
now Trump's friends. And yeah, and you're a buddy of Trump as long as you do and say what he does. And that was the guy that was the kid that I always remembered. I don't know where he grew up, Tom. That was the bully. As long
Mhm.
as you went around with the bully and said and did what he did, you were great. The moment you talked about it or said, no, we don't want to do that, he didn't want you around. And unfortunately, he's playing this on the world stage. And I'll add one other thing. China has done an incredible job uh, holding off what many people continue to predict of this, dramatic collapse of China and so forth and so on, especially after what's happened here and all. And, he likes to say, oh, we're great friends. Well, I think by now, two great friends would have gotten together to try to work this out if they really were friends.
Mhm.
So a lot of this is pomps and circumstance by Trump, and he's the greatest marketeer that I think's been in the White House in my lifetime. But I don't know how long that marketeering can keep up. And I think the realities are starting to creep into some people's minds.
Peter, you mentioned that this is basically the most political or politicized the Fed has ever been in your memory. Do you think, or what is the reality around Trump actually being able to fire Powell, or does he just make his life miserable enough that he ends up quitting despite the concern for his legacy?
My advice to him, which he's not going to listen to, but my advice to him is keep him there. Because if things don't work out, if the trade stuff doesn't work, the economy goes into recession and all, point your finger at the guy that you basically said was all his fault to begin with.
Mhm.
You'll have at least a scapegoat. If you terminate him here or replace him and the economy doesn't work out and it goes, then it's all on you. And here's the other thing that you got to remember, Tom. We have elections a year from November in the White House. That is, I'm sorry, for Congress. And there's always a tendency for some backtracking, whoever might have changed when the last time it changed from one party to
Mhm.
another. There are going to be Republicans now that maybe in the early days or just before he got elected were willing to stand and be seen with him. Things start to go a little wrong on the economy and all. I don't think he's going to have that. And the loss of just Congress or the Senate in his last 2 years, you can just toss that away. It'll just be, if you think he's crazy now, I mean, just imagine what that'd be like. But absolutely nothing will get done. And we're next to nothing getting done now. Passing legislation, let me just add this quickly, Tom, if I may. The bulk of our financial planning business is small business owners throughout the United States. And the one overriding thing that you'll hear from a small business owner in the United States, in any part of the United States, is there has not been good legislation out of Washington to make it better for a small business owner in 20 or 30 years. So it's not just Trump, but Congress in general. And don't let people fool you. It's the small businesses that have been the backbone of the economy to the United States. This is a man that's not looking at them. He's dealing with all this corporate stuff and going overseas and saying, I'm getting hundreds of billions here and all. Meanwhile, small business owners, farmers, the backbone of America continues to be weighted down, and many of them not able to continue going in a manner that they're used to and have to consider exiting. And this is something that's not being caught up by Wall Street. And here's why, Tom. 86, the top 10% wealthiest people in America own 86% of all the assets. The next 40% own the remaining 14%, and half of America really doesn't have any assets. Wall Street caters to that top 10%, and they focus on that and look at that. But the bulk of America and what makes up the economy and all is the rest of the group. Much of America is not moving forward as that top 10% is. Eventually, when the spread becomes too big, that this group pulls them down. These guys don't make enough where they can bring everybody up,
Mhm.
and that's what we're getting to. We're not there yet, but we're getting pretty close on the economic side. We're also getting there socially because of the unrest and all, and soon politically if he loses some of the political clout that he had coming into this administration.
Mhm. Well, Peter, when we think about, let's say, the market's reaction to this news story today, as you put it, and the stock market's basically going down on that story, would we not think that the stock markets would have the opposite effect to, be more accommodating to a more dovish Fed chair, despite him still needing all of the other Fed chairs vote, or all of the other Fed presidents votes? Would we not think that the stock market would react positively to that, to somebody that ends up being more dovish?
Yeah, that was what my alert said. That when before he came out and said, "No, I'm not about to fire him." My
Mm,
alert was, even though the stock market was currently down at the moment, don't be surprised that it goes up, and that the "Don't worry, be happy" crowd that makes up most of Wall Street will use this as yet another reason to be bullish on stocks for the reasons that you spoke about: more accommodative, lower interest rates, more easing. Yes, clearly, my view was it's a tremendous story for gold. It hurts bonds on the long end, because even if you get a guy or gal, for all we know, that comes in there and has a complete opposite, we should be cutting rates. As you said, there's still Fed governors that you have to get, across and join that. But even if they start cutting, the surprise can be is when they cut rates the last time.
mhm.
Remember, when they cut rates the last time on the short end, the long bond went up 100 basis points over that period. And that could be something that we're seeing here too. And this is at a time when, even though the dollar right now is in a little corrective phase from a very, hard bear market, that and the fact that I don't know if there's a lot still people overseas that are willing to buy our assets in the manner that they did. Tom, over $25 trillion net came in from foreigners in this millennium into U.S. assets. All we have to see, and with a dollar weakening, we will see some of that leave. All we have to see is that start to flow out somewhat. It's going to be very tough to finance bonds. And
Mhm.
that's the other concern I have, that if he does all of this and he lowers interest rates, which really makes them less attractive. Look at Japan. Japan has seen an unbelievable bump up in rates, to the point now where they can really start to have some serious troubles if that keeps going on. This is all at a time, like I said, when we just spoke about earlier, we're not the most favorite people in the world right now. Our fan club has shrunk dramatically around the world. So yeah, I agree with you. Initially, the stock market could, and that could be the melt up that some people felt we need to have before it all ends. But I also think that the longer term, it's a big negative.
Peter, what do you think drives that melt up? You and I have spoken before, and kind of looked at what some of these drivers could be, whether it is passive, whether it is, this new executive order that Trump is trying to push through, that where 401ks are allowed to invest in private equity. Like, where do you think that capital comes from to push the stock markets into a melt up phase?
Well, there's still a lot of capital around. Like I said, we've had trillions of dollars come from overseas that hasn't really exited yet. We have this, and by the way, I don't know if I had a chance to tell you this. I certainly want to say it publicly for your viewers and mine. The gentleman you had on a few days ago, Michael Green, who spoke about the situation with passive investing, and I gave you credit because I showed everybody, was the most thorough, spot on commentary of what is happening because of passive investing and what it could lead to. Kudos for that. That was probably one of the three best interviews I've seen in years. And I'm not
That's good to
saying
hear.
because you have me on, it's no big thing if you don't have me on again and all, but it really, really was. And I would encourage anybody who hasn't yet seen it to go to your website, look up Michael Green, and watch that interview. Phenomenal job, Tom. Uh, the passive investing is a unique phenomena, as Michael explained. It is changed dramatically. And let me take a moment to explain that. In 1984, when I started in the dinosaur age uh, of investing, almost 90% of the trading was the public. It was only about 10% institutional. There was no computer trading whatsoever. Now, as you know, over half the money is in passive funds. This is not actively managed. This is not managers and responsible thinking, I'll buy this, I'll move to this sector, whatever. It's merely trying to track an index or an indice, and automatic money flow into it automatically creates buying that creates more buying. That's why people look and go, wow, the top tier stocks are doing well, but the Russell can't get out of its own way because much of this is concentrated in the upper echelon of stocks. The problem has, and as your gentleman so rightly pointed out, if and when, and it will be when, it won't be if, but I have to say if and when, that reverses, the opposite happens. And so the melt up initially because of this enthusiasm and now freeing up, the thought would be is this, okay, you got these 401k money, they can go into private equity, buy it. Those people with private equity get freed up. They put more money back into the general equity market. That could be a reason. I don't think the rally would last long. When we say melt up, I'm not talking about a 20 or 50% run over 6 or 12 months. Maybe a matter of weeks before people realize that that's really going to come back to haunt us. But the bigger concern is how the public has now shown it's beating all records of how it's investing in the market and has now gone down to the lowest echelon of stocks and being the biggest aggressors, which is a real bellwether at a time when major institutional players are moving out of the market. Could it be the first time?
Institutional and insiders, sorry to interrupt.
And insiders. So is this the one time when the public is smarter than the pros? You can never say never, but I wouldn't bet on it.
Peter, what are other, let's say, crises that you have on your radar here? You know, you've written about basically 11 things that you're very concerned about. What are some of those, major concerns that you have at this time?
Well, unless this is a 10-hour interview, I'm going to have to shorten them because that's how long it would take to explain. So here they are. In the one that everybody knows is the debt crisis. It's insane. It's insanity. We're going to be soon at $50 trillion, put a 5% interest on it. That's $2.5 trillion in interest. The best year we ever had as a country so far in revenue is $6 trillion. Even if that gets bumped up some, it's no longer can we pay any of this back. That's long forgotten. We're going to get serious concerns. Can we even pay the interest? So that the debt one is long talked about, but the realization of it becoming real is now before us. The second big problem we have in the United States is a retirement crisis, Tom. Now, on Wall Street, you can watch the financial ads and you can assume that everything is going well, but when 2/3 of Americans are working paycheck to paycheck, they don't have the ability to put away enough discretionary income to save for that last 20 or 25% of life where we somehow live in comfort before we pass. The problem now that's accelerating that is because of a lot of other high costs, inflation, things of that nature, we're now seeing people who are already retired have to come back into the workforce. It's not uncommon now, no matter where you live in the United States, to walk into a retail store or something and see somebody 75, 80, or 85 or more working in the store and learn that they had at once retired, but had to come back and work that. So there's a retirement crisis, but there's an offbeat of that that's just going to be as bad. And that's what I call the aging crisis. So Pete Grandich, who you're speaking to, is 69 years old, hopes to live another 10 or 20 years if it happens. But at 79 or 89, and I need a $500,000 operation, whatever it is, to keep me going, there's going to be some 39-year-old guy who's taxed up to the yin-yang, who knows now at that point in time, even if Social Security some exists in some manner, he is never going to see it and is going to say, whoa, this Grandich guy, he had lived a good life. I can't pay any more taxes to keep him going and get this. Let him. And people say, that'll never happen. I told, well, look up in Canada. Canada and 3 states already in the United States have laws where they encourage people, literally encourage them, if they're destitute financially or health-wise, commit suicide. That solves the problem. So I believe there will be an aging crisis with that. Now, the two crises that people don't talk about, but they are starting now, that I've been talking about a couple of years, and that's our infrastructure and natural disaster crisis. Natural disasters, obviously, we have no control over. But for whatever reason, global warming, I'm not here to say it is or isn't, whatever reasons, natural disasters have definitely increased. The problem that I said would come is because we've ignored infrastructure for so long in this country. Let's not forget that the original financial crisis in 2008, when Bernanke and Obama stood in front of America and said, listen, We're going to bail out these banks and all and create all this money because they're going to put the money into infrastructure and we're going to rebuild America. Yeah, it basically stayed on Wall Street, never made it to Main Street. And so we've had a deterioration of infrastructure, let alone that everybody, I just had some guy call me from Wall Street, tell me why I had to own this AI stock and all. And it's true, you know, maybe they're going to have all these places. We can't even provide electricity now, Tom.
Mhm.
We are having natural brownouts and blackouts or reaching capacities because of heat waves and all, let alone where we're going to be 10 or 20 years from now with all this demand that's supposed to increase and all. So the infrastructure crisis, and now we've seen it, we've seen some of the horrible things that happened in LA, the Carolinas. We just had floodings here because infrastructure isn't built to sustain or overcome those natural disasters. That's only going to get worse, and that's costly. You know, no one's talking about it, but some of the estimates now is that the LA fires alone will be over maybe $500 billion to finally fix and get everything back to the way it is. And now you start talking about what happened in the Carolinas and other places and all. So infrastructure and all. Then, of course, the one that people don't like me talking about, and I get the most hate mail. And I've only started speaking about it recently because I was alarmed to find out to the level that it's been at. And my personal faith also brought my eyes to open to it. And that is the continuous movement here in the United States of the Islamic movement, a faith and way of living that's dramatically different than Western civilization. I'm not saying which one is right or wrong, but no one will argue that it's a totally different way of looking at life and how you're living. And what I say to people is here in the United States now, when they start to see how that growth is happening here, if you want to know what could happen, we just have to look overseas to places like England, France, Ireland, and all, who just 10 or 20 years ago were basically in the position we are in now. And it's not talked about. It's still hammered by anybody that tries to speak about it. I get hate mail and I'm nobody. I'm not some big podcaster guy or something of that nature. But it is an issue that I think is going to become more paramount as we go forward. And you know, there are others, but those are some of the primary concerns. And I don't think the typical financial advisor, that's another, I don't want to say a crisis, but it's a concern of mine. You know, here in the United States, I can't speak to Canada or elsewhere, but 2/3 of the financial advisors now have only been in the business about 15 years or less. They've experienced one downturn. They basically have learned how to drive on a one-way street.
Mhm.
And so has the investors, the investment community itself. They have no idea what two-way traffic or, God forbid, a traffic circle comes up. And so my concern is when the inevitable bear market comes, from wherever it comes from, whatever level, I'm not here to predict that and all. But I think that it's going to be more troublesome because the professional community has no idea what to do in those type of circumstances. I don't wouldn't call that a crisis, but I do think it's a concern that I have that if they can't understand, I'll give you a quick example, Tom. This is, if you don't mind, I'm taking up your time on your video. I had to give a speech a few months ago to a bunch of young financial advisors. A friend of mine has a brokerage firm. And we're sitting there, and I was clearly the oldest guy in the room. So I'm sitting at one of these tables, and my friend is running it. And he says, before we have lunch, I brought a speaker in. And one of the things he's going to talk to you about that you guys better know about, and gals, is Brics. And these two young guys next to me, both licensed guys, I found out less than 5 years, working for him, say to another, he's going to talk about the housing market. I mean, I say that preposterously, but I can tell you right now, most financial advisors do not understand what the Brics are about, what they're doing, what they're implementing, and what it can lead to here in the United States. And that's why I'm very concerned that not so much the ethical part of the professional advice, but the knowledge part or lack of knowledge part could be a hindrance when the inevitable bear market shows up.
Mhm. Well, Peter, what are some of the developments that you've seen in the BRICS that are concerning to you or that are worth considering, at least in this time where, you know, we've seen a lot of talk about them, then it kind of goes quiet, then we have another meeting. You know, it seems like this is a development that is very important that we need to be kind of keeping abreast apart.
Well, they're very happy from their end that it's not getting the news right around when Trump was elected and inaugurated. We brought up Brics. They like to keep it that way themselves. So I made a huge decision that I don't think 1% of people did. At the end of 2021, I concluded that the Brics were going to be a formidable key component to world trade and et cetera, et cetera. And because of that, gold was going to go up a lot. If
Mhm.
you look back at even our interviews and all. And I chose to sell all my general equity stocks but one and treasury bonds, anything related to that, and own physical gold because I believed what they're going to do, they recognize that they are not going to be able to use a fiat trading system to however they set up the trade, whether it's just between themselves or they want to take it to where it's world trade and get a new world currency, which still may not be the case. But whatever it was going to be, they recognized that gold had to be a part of it. And therefore, you got to own gold. And that was the main reason why I did that and own gold. That still exists because they're still moving towards that. The issue that I think that's going to play better for them is what Trump has done. And it was one thing, if you're a country right now and you were considering being part of them, this is what they're going to say to you. What he did to Russia and what he's now doing to people, and America is not just going to be Trump. It's going to be, look what America's done. You want that happening to you? Or do you want to build around that and work with us and so forth? And that's why I think the BRICS are just going to, their growth is going to be stronger and stronger. I think what people need to understand is that history has taught us, and I'm not you have much, I watch all your interviews, you have much better people to speak to this. But one thing, try to remember, no one ever stays the world leader forever.
Mhm.
And the inevitable decline of the United States, which is underway and ongoing, it would be ironic that it would accelerate to the downside because of what Trump did when many people who elected him assumed somehow he could turn this around and shift it, not only make America great again, but make America like it was 30 or 40 years ago. That's the misconception. So let me tell you this. The woman that's sitting in the other room, my wife, is a Trumpster. I'm not. So you can understand we don't have a lot of political discussions at the dinner table. But the bottom line is there has been this perception by people, and it was enough to get him elected and all, that somehow it could be like the old days. The old days are gone. They're gone in the stock market. When you watch a financial network and you watch them talking from the New York Stock Exchange, that's a museum. The trading really doesn't even take place there anymore. It's completely different, the markets, than they were 30 or 40 years ago. And you better start to understand that the world is moving away from the United States, not closer to the United States. And what will be those ramifications? Now, if you're just trading, Tom, and you only care about the next few days or weeks, yeah, maybe Brics don't play a role. But if there's anybody left, because when I entered this business, long-term investing, every research report had a 3 to 5 year outlook. Now they don't go past 12 months. But if you do invest for 3 or 5 years, you better understand and appreciate what is unfolding with the Brics and get a grasp and follow it. Because if you do what I do, Tom, I don't know a lot of people say this, but you should. Don't just read US financial media. Read European based financial media. Read Asian based financial media. Because there you'll learn that what the US financial media is telling you is not the perception in the other places. And that's where growth is. Growth is no longer the United States helping the whole world go forward. The key to the world right now is as much China as the United States. And when you throw in some others who are moving away from the United States, then they overcome the United States power eventually.
Mhm. So, Peter, as you consider, let's say the stock market moving forward with a possible melt up, and then obviously a kind of crash situation that presents itself after that, how do you see, let's say, the safety or the attractiveness of mining equities within that framework of risk that you're looking at?
So if you said to me, Pete, hey, stock market, I saw the future one day it falls 20, 25%. I can tell you the mining shares are going to, if they don't decline that day, they'll do what they did after the 87 crash. Because the day of the 87 crash, 11 stocks were up and 8 out of the 11 were mining stocks. Gold only gave back what it gained the day after the crash, yet the mining stocks were cut in half because they became liquidity.
Mhm.
So in a dire crash like very fast, they'll just become general equities, but only for a short period of time. Because unless the metal price corrects with the stock market, eventually people will gyrate back to them. But outside of a crash, this is a near perfect storm now for gold. Tom, I used to interview me. I used to tell you up until a few months ago, owning silver was like kissing your sister. It
Right.
wasn't favorable to me. You know that. I used to get a lot of hate mail, but I recognized and believed when it dipped under 30 earlier this year, and I looked at this massive shorting, and of course the supply and demand scenario for silver has changed very favorable. I became bullish and put it in the same camp. But copper, that was my favorite metal for this year, and it's performing really well. And uranium, I'm back in uranium after catching the first wave and getting out, fortunately enough. So I don't think, other than that meltdown, if it just goes into a bear market and all. In fact, I would tell the people that will be watching this in the next couple of days that if you own the juniors and you're still going, why aren't they going up a lot? I mean, they are going off the bottom, but they're still not going. It's because the things that have been competition to them are still attracting everybody. The general stock market, cryptocurrencies. But one of the things of this news, I'll give you an example in copper. A lot of people didn't know the true supply and demand scenario. But by him putting the tariffs and all the stories ran, what I'm hearing from mining executives and what I just see from the work on my own is generalists, which are people that don't normally just focus on the metals, they invest anywhere they can. It opened their eyes.
Mhm.
Why is this happening with copper? And then when you tell them the story, well, what do you like? That's the next scenario. So we're just starting to see flows leaving some of the other areas, focusing on the metals and all. And Tom, there's a huge supply and demand scenario positive, clearly for copper, clearly for uranium. And the gold is because central banks will keep approaching it. And the silver market, squeeze those guys till they can't squeeze anymore. I mean, that's been a heavily manipulated market that's finally breaking away from that and all. So I other than that total crash scenario of 20% in a day, I don't see mining shares being impacted other than for an extremely short period of time.
Mhm. Well, what about the more, let's say, systemic risk to banks and therefore brokerage houses that end up getting, massive, massive derivatives, like because of all of those risks? Is that something that you're concerned about?
Well, you're always concerned about it because we don't know to the level of how bad the derivatives are. It's a story that's kind of been swept under the rug that maybe 10 years ago people were hollering about the dangers, and it's clearly there's more of them. I think the difference at this point in time is the banking system had an opportunity to, in a sense, cleanse itself of some real high risk stuff. Where it's left, what they're still anchored by, people forget that they still sit with a lot of net losses in bonds that they had to buy, even some insurance companies when they were 1 or 2%. But time has allowed them to weed out of that. I don't think the banking crisis that was feared 5 or 10 years ago is as severe now as it was. I'm not saying that they're all hunky dory and nothing can go wrong. I know there's a lot of people, I know they talk about they're going to keep our money, we're never going to get it out. You can never say never that won't happen.
Mhm.
But the strong chance of something that would change the way that I'm approaching investing because of that doesn't trouble me.
Mhm. Peter, do you have any hard rules around, let's say, how big of a piece of your portfolio that mining equities represent within your portfolio, or rules, let's say, around rebalancing stocks that are actually performing and reinvesting in other ones that you like, but maybe aren't catching the attention yet?
So having lost not once, Tom, but twice more money than I ever imagined as a young man I can have just in mining shares and junior stocks, just closing out a position that for the last few years I raved about and took the largest loss ever I had. And of course, I have a fan club online because of that. I don't know if I'm the best person to speak about that because a nickname that I kind of gave myself after many people suggested it to me in one way or another, Riverboat Pete. I've always been a speculator. And let's understand one thing, Tom. Speculating and gambling is the same thing. Wall Street just created the word speculating so they don't have to say gambling.
Mhm.
But it is serious. And you really have to financially and mentally be prepared to lose part of all your investment. I watch folks, I don't go to conferences anymore, but I used to watch folks come into a conference, hear somebody speak about a wonderful company and all, and they already spent in their mind what they're going to make before they even purchase the stock. Same thing in financial planning. We're big believers in cash flow, not net worth, and people don't have a plan B. So one of the things you have to understand, especially when you get into the lower echelon of the mining, the exploration stocks, failure is the norm in that business. Eventually, if I have 10 juniors, no matter how high I may be at any one time in them, 3 years from now, somebody's going to say, hey, remember the guy Grandis said A, B, C? They didn't work out. They
Mhm.
just don't. The thing that you're hopeful for is the ones that do have such a high return that they make up much more for that. I have a company that I've been investing in. I was buying it at 12 cents. Today they put out great news. It's 46 cents. Well, people have to realize that's basically a 300% gain. So even if I had three other juniors that went to zero, okay, I'm at the same starting point and all.
Mhm.
So one of the things you have to do in the junior market is you have to diversify. And you have to have several of them in order to have. But I still think you start with physical metals because you need to have them the same way that you have insurance on your home and on
Mhm.
your car. You don't want it to go wrong, but if it does. Now, is gold as attractive at 3,400 as it was when 1,300, maybe when I started talking with you at 15 or 1,600? No. But here's another thing that maybe people don't speak about, Tom. And if you give me 2 minutes, I think it's important. Before I entered the brokerage business, I was working in a warehouse, started in the stock market, and my broker that I used at a Merrill Lynch office said to me, Pete, the Dow has been between 700 and 1,000 for 13 years. In fact, we don't expect it to go high. In fact, Business Week ran this major front page story that equities were dead. Stock market's never going up again. And a guy came out of, I think it was Gainesville, Georgia, named Robert Prechter Jr., who no one knew,
Mhm.
and came out and was touted that he's talking about 3,600 on the Dow through this thing called Elliott wave theory that really no one knew about at the time. People
I've
scoffed.
interviewed Bob.
I remember my broker saying, this guy's nuts. It's never been 1,000. How's it going 3,600? Well, we all know over years it went to a lot higher than 3,600. I'm not saying gold's going to 40,000, but one of the mistakes people would make here is to say, well, gold can't go to 6 or 10,000. That's the same thing that they said back then. There's no reason you can't say that. You have no idea what it can be. It's just not as relatively as cheap as it was just a few years ago.
Mhm.
But I do think if you grabbed my two loves of my life, my wife or my daughter, and said which one is going to at least hold what you have or be worth more over the next 3 to 5 years, gold, stocks, or bonds, I'm still picking gold.
Mhm.
And so I still think because of that and the great need for metals in business, I think this is a near perfect storm for the copper companies, especially companies that are both looking for gold and copper, and the uranium companies. And I was never a uranium guy till a few years ago. And but that story now has just but got as good as possible as it can get. And yet, even though the shares have almost doubled from when I re-entered them back in April, they still have a lot higher to go over time.
Mhm. So, Peter, what are the major, let's say, trends or metals that you're looking at for the rest of this year? Is it uranium and copper still?
Well, the uraniums have moved so much that I just don't. I mean, our list is almost up 70 something percent, Tom. Normally, something going from April to July up 70%, I'm selling it. But they're
Mhm.
just, the stories are so good that I want to hold it. I think the copper story is the great story. Listen, he will back down from 50. I'll go out and say the prediction. He will not stay at 50% on copper. It'll come down somewhat. But what it's done is, it's made people realize. And when you really look at the copper story now, even the copper bearish folks that used to say, oh, it's Dr. Copper if the economy's going to weaken. Yeah, you know why that worked back then, Tom? Because there was large supplies of it. So yeah, if the economy went weak, of course the price went down. That doesn't exist anymore. And so where also you can look now. I got out of West Africa 7 years ago, said I would never invest there because these folks are going to nationalize these mines. And look what's happened in Mali now. They're flying in and taking $100 million worth of Barrick's gold. So the world has shrunk where you can go and find. And the other problem with copper, the grades, what's left in the world, the big deposits, are very low. We need a sustainable price well above 5 for many months, if not a year or two, before large sums of money of mining companies are going to go anywhere and elsewhere to try to find new deposits. Mm-hmm. So that story has a long, strong undertone to it. The same thing with uranium. You know, the need, people realize wind, that's a gone theory. Solar, yeah, until we have storms and these solar farms get destroyed. And now, 20 years ago, you go to a senator, hey, I want to think of putting up a nuclear plant, not in my state. Now that same senator, can you please build one fast? Because they realize the power. So I think the uranium and copper story are the two strongest. Gold because of the monetary part of it. And now silver can play on the same field with gold. So I think anything related to those would be interesting to me.
Perfect. Well, Peter, it's always good to kind of get your perspective on what is happening here as you look out for the rest of the year. Where can people find you?
Well, they have hate mail. I'm going to give them your email, but no, I have a website, petergrandich.com, but most of my communication now, all my communications end up on my X page. So whether they're through YouTube, a blog, an X page, that's probably the best places for people if they want to learn more.
And of course, that's at Peter Grandich.
Yes, sir.
Perfect. Peter, thanks so much for your time today. Always a pleasure.
Always. And let me just close again. If people have not watched that Michael Green, I'm probably the only guy you ever interviewed that's plugging another guy that you interviewed. But that was one of the best interviews I've seen in a long time. And I hope to remind people again to look at that interview. And what he speaks about passive investing is a must. You must understand what he's speaking about.
Mm-hmm. Well, I appreciate that feedback, Peter. And I found it quite profound as well. I went back and immediately listened to it again. So I agree with you. Appreciate it.
Thank you, Tom. God bless.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.